Hello everyone, welcome to this session. So in the previous sessions we discussed the theoretical framework regarding financial crisis, and we initiated a discussion about 2007-8 crisis. So we started saying that the 2007-8-9 crisis was a subprime crisis. So especially in the year 2007, it was mostly a subprime mortgage crisis, and in 2008 it became a full-fledged financial crisis. So coming to this one, we also discussed how it is called a subprime crisis, because it was a subprime crisis because of the result of excessive amounts of loans made to subprime people, that means who cannot afford them, and excessive amounts of money thrown into the mortgage sector by investors for high return. So the low rate of interest, rising home prices, mortgage securitization brought huge gains in the financial market. So we also seen that actually most mortgage lenders resell their loans to financial firms, who then in turn bundle thousands of mortgage loans from different lenders into mortgage backed securities. These institutions then slice these mortgages into residential mortgage backed securities. So that means RMBS means securities that are backed by collateral, and here the collateral here being the mortgages held by subprime borrowers. So here actually the mortgage means nothing but the loan taken to buy a home. That means the home itself become, the mortgage itself become the collateral. So the problem issue here is that all the individual loans, all these were clubbed together and made into a mortgage backed securities, which was bought by financial firms, mostly investment banks, from the banks who lend these loans to subprime borrowers. Then again we are going to see that this MBS further sliced into mortgage backed securities are further sliced into collateralized debt obligations. CDOs are pools of bond securities that are grouped together to help diversify risk, and risk agencies rated different tranches of these structures, and the Wall Street firms sold these to institutional investors, including mutual funds, banks, hedge funds, to other commercial banks, and pension funds. We need to see that actually this RMBS actually another kind of bonds in fact, and these bonds is a new financial products. This was actually originated from the mortgage loans. So the main stakeholders included in the 2007-9 crisis, where one is homeowners, mainly subprime borrowers, subprime people who otherwise not eligible for, in normal condition they are not eligible for a home loan. Actually their credit score is much lower than the prime customers obviously. Then real estate agents, then the mortgage lenders, mainly banking institutions, and Wall Street firms who are the investment banks who bought all these loans and then converted it into mortgage backed securities, that is bond, a kind of bond instrument, and then the rating agencies who rated these financial products, and the investors who bought these RMBS and CDOs, who are the real estate investors who want to make huge gains out of the real estate boom during this period. Before we go further, let us make a clear definition. What is this mortgage backed securities? These are like bonds. Their shares are also traded in the secondary market, but the only difference is that they pose a bigger risk of loss compared to government bonds, and these are actually private bonds and not the government bonds. So they obviously face the risk of high default risk, and hence to compensate this risk they offer higher returns. So, the investment banks started buying the mortgage agreements from the retail banks, and this way they became entitled to receive a monthly payments from the borrowers. So, that means the Wall Street firm or the investment banks they bought all these loans from the retail banks who lend these loans to subprime borrowers, and then they became entitled to receive a monthly payments from the borrowers. Why the need for a mortgage backed security? It emerged in the year after 2000. So, in year 2000 we have seen that the Fed fund rate, because of the anticipated recession or near recession, and in year 2001 we have seen that thereafter Fed has reduced the Fed fund rate. Fed has reduced the Fed fund rate. We have seen that there was nearly huge decline in Fed fund rate. It finally became 1.75 in 2006. So, that means the yield from these are also related to the rate of interest from all other securities, which we have seen in one of the previous sessions, that all yield, that the rate of interest, all of them move together. That means when the Fed fund rate were slashed, when it's reduced, that means it was earlier it was more than 6%, when it became 1.75, then you know that the rate of interest has declined further and further. So, the yield from government backed securities also declined. So, all risk free fixed income instruments were yielding very low yield during this period, especially after 2000. Hence, bankers were busy inventing a low risk high return investment options. So, this led to gave to rise to the mortgage backed security, the birth of mortgage backed securities. And MBS had mortgage loans as their assets, and it was considered safe. So, because the collateral itself, the mortgage itself is the collateral. So, at a time when the treasury bills were yielding less than 3.5% return, and MBS could promise 5 to 6% fixed return. So, you could see that the big difference actually this RMBS have been giving, that means high fixed return. So, at that time it was considered the early periods of in the 2000, the early years, it was being considered as a good investment. It was very liquid at that time and yielding high return. Not only that, the asset price, the mortgage price, housing prices has been keep on increasing in the US at that time. So, investment banks, as I mentioned here, bought loans from retail banks. Several such mortgages were clubbed together to form mortgage backed securities. This MBS was valued based on the future income potential, that is the monthly payments received from home buyers. So, putting to this one a little bit some graphical representation. So, we can see that these are the home buyers that who bought loans from retail banks. So, they make a monthly payments actually to the bank. Actually, they have taken a loan from the bank, and then in every month they will be making a repayment to the bank. So, that means there is a mortgage agreement, right. So, that is the first stage. Then investment banks come into the picture. Investment banks buy these loans from the bank. So, in return what they get, that actually the payment which is being given by the home buyers, it will come to the investment banks, right. This is the monthly potential earnings or the return from this investment, that the mortgage. Then coming what investment banks did by using this one, they converted clubbed all together into mortgage backed securities, and this mortgage backed securities, this has been made into shares, and then it was sold out to the investors. So, it was sold out to the investors. What the investors will get when the pays money to buy shares to MBS, and then they will be buying it from the investment bank. So, when the these owners of this mortgage, that means mortgage borrowers, when they make a monthly payment, so that is actually the return for these investors. It will be going through the investment banks. So, you can see here is that borrowers, they make monthly payment to the investment banks, then they will be lending this one to the investors who are invested in this mortgage backed securities. We can summarize present this one in a figure like this. So, here what we can see that people all over the country they take out loan. This is individual, that the home borrowers, mortgage borrowers, that they who took loan. Then the investment banks, this actually all these are individual borrowers, and these securities are grouped into tranches by levels of risk earnings for bond holders. So, this actually pool that RMBS, this has been rated by rating agencies. So, the rating you can see the AAA, AA like that. This has been done, actually it has been made into different groups of RMBS, and each the RMBS all these loans together they have been made into different groups of further categorized into based on the default risk, made into different groups of products, is made further slicing. Then you know that those who buy AAA rated bond, that RMBS, this bond, they will be getting obviously you know that higher the rating, that the lower the default risk, they will be getting low rate of interest. Low rate of interest will be low for them. However, of this group whoever is making, suppose of all the homeowners, so the home loan takers, if they suppose out of this 40%, the first 40%, whoever is making the loan, suppose not everyone is making loan repayment. So, 40% is making loan repayment. So, this will be given to the AAA rated RMBS holder. So, subsequently if additional next 10% makes, then it will be gone to AA, then another remaining another 10% makes, then it will be gone to in this way. That means to that means out of this all the owners of the house, mortgage owners, when they make, because there is a default risk, right? If everyone makes payment, that means all the 100%, that means 10% of the homeowners, if the mortgage borrowers, if everyone makes repayment, then all these people will be getting, whoever is holding this RMBS will be getting, and within that you know that whoever is holding AAA bonds, they will be getting less income because the rate of interest is less agreed, and those who the unrated or BBB, they will be getting higher return, because you know that higher the risk, higher the rate of interest. However, you know that the default risk is there, this default risk is there. Suppose within this tranche, you can see that whoever is making, only a few people are making, not everyone is making, that is in this way you can see 60% of the homeowners are making repayment of that loan. So, that means mainly the return, the payment will be given to AAA holders and little bit to the AA holders, but nothing for here, nothing for here, nothing for here. Same here, if there is a default, then you know that people who the investors who bought low rated RMBS, they will be getting actually nothing here, right? They are not getting payments at all. So, what they did, so you know that the ratings, that the lower yield, higher rating but lower yield, but here higher yield, that the lower rating, but actually they will be lastly paid. That means if everybody make the monthly repayment, then actually those who having this RMBS, that the BB minus, that the unrated and all, they will be paid lastly, provided that everyone pays, right? So, that means if 20% of the people not making payment, then who will be getting affected? These people won't get payments. So, what further interesting thing is here, anyway there is this RMBS was categorized into different products, different financial products, bonds with a different ratings. So, within this again those with the low rated, that means low rating, that triple B, BB minus negative, that means this lower rated bonds RMBS has been further classified as CDO. That means this structured financial engineering, because of the financial engineering, the development of new sophisticated financial instrument which led to the structured credit products that paid out income streams from the collection of underlying assets you know that this has been further categorized into designed to have particular risk characteristics that appeal to investors with differing preferences. That means a kind of asset transformation has happened here, and this RMBS with a high risk, that low ratings, this has been further, the notorious one is that they further made into a new product called CDO. CDO means that the collateralized debt obligation. This is one of the notorious of these products. That means the risks associated with financial innovations are not limited here. That means just to make RMBS, but they further made into new group of product called CDO. CDO, again interesting thing is here, we know that the CDOs are originating from higher default risk bond, the high default risk RMBS, but this has been made a new product called CDO. CDO again made into different tranches, again with ratings, that within this also there is AAA rating, AA rating, A, B, unrated, etc. And it's not stopping here, this has been further within that, suppose within this unrated, within the bottom, that is the high default risk CDOs has been further categorized into CDO square. So that means it's become very complicated products. So that means completely new products in the market, and even the people who are buying this, who are investing in this, are not fully aware of it. Because it's very complicated product and very difficult to understand how this product originated, and many individual investors as well as many institutional investors, they invested in this RMBS, CDOs and even CDO square. Let us now see what are the possible reasons. Then finally what we are going to see that the subprime crisis, it actually after a certain point of time it collapsed, right. So that let us before going to that, let us put that sequence of events, the crisis by in sequence of events. One possible reason we already seen, the government policy through legislations like Community Reinvestment Act, which encouraged giving loans to subprime people, borrowers. Then another thing we have noted, Fed's policy of reducing the Fed rate, that means the market rate of interest became very low. That also tempted financial system to engage in RMBS. And about borrowers, you know that many borrowers bought a home they couldn't afford, but hoped that prices would continue to rise and that they could resell their homes for a profit sometime in the future. Unfortunately, price went up in the wrong direction. So mortgage brokers, what is their stake in here? So about borrowers, you know that many borrowers, they are getting loan. Actually, even though they didn't want loan, the bankers are behind them, mortgage brokers are behind them to give them loan, and they also see that the mortgage prices are shooting up, increasing. So they thought that it's going to be a capital investment as well. And about mortgage brokers, they are interested in their commission. They have been blamed with steering borrowers to unaffordable loans and appraisers with the inflating housing values. So the mortgage lenders, especially the bankers, retail bankers, high fixed cost of the loan originator platform motivated the mortgage lenders to generate as many loans as they could, and then sell them quick in order to compete with the other mortgage lenders. So what they did, that they relaxed lending standards. So you could see here that the retail banks, when they gave the as many loan as possible, so immediately they could make a resale of these loans to investment banks, right, that we have seen. So about investment banks who bought these loans from retail banks, because for them with money easily available from banks, investment bought individual home loan from banks, consolidated them into big packages and chopped these into smaller pieces that serve as collateral for the issuance of tradable mortgage backed securities. So investment banks backed subprime mortgage securities, they without verifying the strength of the underlying loans. And coming the rating agencies in the picture, we have seen that rating agencies are there, credit rating agencies, they were making millions of dollars in fees from Wall Street mortgage desk, because rating agencies appear to have been too free in giving outpriced AAA badges, that the high ratings for structured products, especially CDOs. This is partly because their models were faulty and partly because of the appraiser is paid by the seller instead by the buyer. You know that they have been paid by the rating agencies, are paid by the investment bank and not by the investors. So, the rating agencies were beguiled by the low default rate of subprime loans, which was partly due to rising house prices, making refinance of loans possible. So, you can see here is that this is the housing price. You can see there is a huge increase, there was sharp increase in the housing prices. That means it became peak by 2006. So, here simply you can see that the homeowners, they have been experiencing a mortgage price boom. That means homeowners, as more people were becoming eligible for the mortgage, as per the basic economic theory, that is the demand theory, we can see that as the demand for homes started increasing, you know that when the demand for homes started increasing, obviously its price will increase. That means more people had money because they are getting loan to buy new home. This created a price bubble in the real estate sector. This created a price bubble in the real estate sector. So, the price of residential properties only went up, and all the borrowers or the subprime borrowers, they began to think that is a capital investment and they can make lots of money, give profit out of this investment, even that taking mortgage loan. So, but obviously you know that when this keep on, that when the bubble happen, when the boom happen, which is above their economic fundamentals. Suppose when the house is actually cost 1 million real, maybe the real economic, based on the economic fundamentals, maybe one house a mortgage cost 1 million, but because of the new financial products, financial innovation and the increased subprime lending, because of huge increase in the demand for house, you can see that the prices has increased to 5 million, and again it is increasing further, maybe 10 million, etc. So, this is means is actually the real, if you based on the real demand and supply, it should be 1 million, but what happened that because of the innovations and whatever the events happened in 2000, the products value became 10 million. So, you know obviously after certain point of time it has to burst, right. So, the most when it started bursting, the more, because everyone was making money out of the business, there is lots of conflict of interest, then mortgage default started happening. So, you know when other mortgage default happened, whoever is taken loan, they began to see that the prices has been started declining. So, when they see that the prices are started declining, not only the effect will, there will be spiral effect, external effect in the market. So, the mortgage default, the other homeowners with the mortgages also attempt to meet their financial obligation, then the prices will be declining in the market. So, that means the entire retail sector was involved. So, then what happened that investors, because there will be default, mortgage default by whoever got this loan, right. Then that means the payments from RMBS started declining, then after certain point of time it started fully declining. So, you can see these defaults will lead to huge losses for investors, and for mortgage lenders are seeing their lines of credit dry up, and Wall Street is unwilling to buy any mortgage loans because of the liquidity crunch. So, hundreds of mortgage lenders have shut down because of this. Then you can see that what about the investment banks. So, the Wall Street firms who issued and underwrote many of the mortgage backed securities and structured vehicles that were sold to investors worldwide have suffered huge losses on their holdings, and business and has become a standstill. So, in addition, all banks have suffered losses in other markets from the contagion, which will likely to continue further, right. So, this is the sequence of events. So, then you can see that in stage 2, this had led to banking crisis. So, that means by the year 2008, it became nearly a full-fledged financial crisis. How come? You know that there was deterioration in the financial institutions balance sheets. That is one thing, one related things, and since there is mortgage default, an increased rate of mortgage default, because of that there was lots of asset write downs, and because of the asset write downs they have to make fire sell their assets and make credit restrictions. Because of the deterioration in the bank's balance sheet, they have to make fire sale of their existing asset to increase the liquidity. Then you know that when there is more supply, or because in a distress sale, when they make distress sale of their asset, there will be oversupply of assets in the market, and obviously you know that the prices of their existing assets also decline, which would lead to the decline in the net worth of the bank. So what happened here is that because of this there was the failure or almost near failure of several major investment and commercial banks, insurance companies, savings and loan association during this period. So we can see that several high profile firms fail, especially by 2000 March 2008, where terms they failed. Then private enterprises sponsored that, but sponsored by the government, housing firms Fannie Mae and Freddie Mac, this also failed in July 2008. And another big failure was Lehman Brothers. This happened, the investment banks, in 2008. Almost nearly these firms almost get started failing during this period. So what we have done here is that so far we covered the basic aspects of the financial crisis 2007-8, and let us continue this discussion of 2007-8 crisis, as well as also discuss some of the crisis, financial crisis in some emerging market economies in the next session. Thank you for watching this video, and see you in the next session. Thank you.